Pleased to see you all again on the channel. I am saying hello, wishing you everyone a wonderful day. Please subscribe and follow if you haven't done so before. Prior to its widespread adoption, this channel provides you with accurate crypto intel. There is now an operational blockchain conflict, not just a theoretical one. Capital flows for the next 2 decades will be defined by decisions made in the background by institutions around the world on infrastructure. Plus, the truth is straightforward. It is not easy to remove the pipes once they are laid. This is more of a competition of connectedness than a competition of currencies. In such a scenario, a network's interoperability is its most valuable economic asset. A bird's eye view is best. A worldwide shift in the money supply is nearing completion. The previous correspondent banking system was designed for a time before the internet. It was complex, sluggish, and capital intensive. The system was dependent on decentralized ledgers, nostro vostro accounts, and stranded funds located in different countries. But money nowadays travels at the speed of light. Tokenization, stablecoins, digital currencies issued by central banks, and real-time settlement railroads are all on the increase, and they are causing a complete overhaul of the world's financial infrastructure. The question has now spread to every asset manager, central bank, and commercial bank in the world. Which systems can we connect to? Now we can see the important thing. Just being a blockchain does not guarantee success. On their own, blockchains don't constitute a network. Ethereum is an independent cryptocurrency. Solana and XRP Ledger are 2 distinct entities. Separate from SWIFT are domestic real-time gross settlement systems. Commercial bank rails are not the same as CBDC pilots. Each of them is an independent island. The internet's packet routing technology made this problem disappear for data. Which server stores a website's files is irrelevant to you. The data is seamlessly routed between networks by IP. The same is true with money, a root layer for value. The idea of interledger comes into play here. There is no such thing as interoperability. It is the bedrock. If it isn't there, digital assets are just isolated experiments. By doing so, they join forces to form a single financial OS. It was with that mindset in mind that Interledger was created. To facilitate the transfer of value across different ledgers, whether blockchain-based or conventional, it acts as an abstraction layer. This transfer is analogous to the ease with which data travels over the internet. Considering the structural implications, consider this. No particular chain is required of a commercial bank. It integrates a wallet system that is linked to many chains. At the time of transaction, liquidity can flow through whatever network is deemed most efficient. The game is changed by this. Networks now compete not for dominance, but for efficiency, cost, depth of liquidity, and conformance with regulations. All right, let's dissect the operational details. The goal of Ripple's participation in Interledger was not to establish an exclusive ecosystem. It was all about speeding up connection. Important for institutional acceptance is the protocol's operation inside global standards organizations and its continued availability as open source. Black boxes are not used by large financial organizations. They settle on criteria. The internet followed a similar trajectory. Instead than dominating ecosystems, protocols succeed by facilitating them. The next step is to apply this to the actual financial system. SWIFT has announced the incorporation of blockchain-based ledgers into its own infrastructure, solidifying its position as the backbone of cross-border messaging. That should be sufficient information for you. Digitalization is not being fought by the legacy system. The key is to adjust to it. Now we get to the subtlety. Settlement interoperability is still necessary for a blockchain to be implemented into SWIFT. Unless it establishes an external connection, a private ledger within a closed network will not be able to remove friction between systems. Because of this, interoperability layers are important. A number of Ripple officials have stressed that the company is not actively seeking to displace SWIFT. Rather, they portray their network as an auxiliary service, especially for organizations who need instantaneous payments. That difference is vital. Devastation is not the means by which financial infrastructure transforms. These occur as a result of integration. It all makes sense when you look at how liquidity routing models have used XRP. The Ripple project, XRP, is an agnostic bridge asset. It was designed for quick settlement and is liquid and efficient. Attempts to make it the de facto reserve currency of the globe are futile. As a connecting tissue, it is vying for primacy. Considering this on a larger scale, think about the implications. Procedures for making payments, commercial banks, government rails, identity systems, stablecoin issuers, foreign exchange venues, remittance businesses, broker-dealers, asset managers, stock exchanges. In the past, these systems worked independently of one another. When they can communicate with one another, what happens? Most crucially, innovation multiplies, settlement risk compresses, capital efficiency rises, and liquidity becomes dynamic. I think we can turn this into something real. Some XRP-based platforms have added support for fiat money, cryptocurrency, and even tokens backed by precious metals like gold and silver. The distribution of these occurs via ledger gateways that connect to many networks, including Bitcoin, SEPA, and SWIFT. That's practical, not abstract. Structural integration is that. For standardized euro payments, SEPA alone links more than 5,000 European banks. Frustration decreases significantly when that can connect to blockchain-based rails via interoperability layers. The XRP ledger has developed this slight advantage over the years: patience and trust. Large institutions need to conduct sandbox testing, regulatory reviews, security audits, and create relationships that span multiple years before they deploy resources, even though newer chains may provide slight speed advantages or unique consensus adjustments. It won't happen in a day. Every year, the financial system deals with trillions. Instead of integrating carelessly, institutions test things out. The fact that Ripples is involved with regulations in so many different countries shows that this has always been an institutional plan for the long haul. Take a peek at the XRP ledger now to see the structural upgrades taking place. Now that permissioned decentralized exchanges are operational, verified users can trade in gated settings with access to liquidity pools. To deal with on-chain liquidity, banks and regulated businesses must first comply with Know Your Customer and anti-money laundering regulations. Thus, DeFi and institutional finance are able to communicate with one another. The functionality of token escrow has been extended beyond XRP, allowing for the programmable locking of assets that are tokenized. This paves the way for private market instruments to be created directly on-chain, as well as bond issuance models and structured products. More and more assets are being tokenized in the real world. Approximately $25 million worth of tokenized real-world assets were recorded on the XRP ledger at the start of 2025. There was a multiplication of that amount in less than a year, as it soared above $1.5 billion within months. That is more akin to institutional experimentation than retail speculation. This is becoming more than just theory, as sovereign-level projects like Bhutan implement CBDC infrastructure using private XRP ledger architecture. Right now, we are seeing the digital revolution of sovereign nations. The system in Bhutan incorporates digital identification, retail payments through QR codes, and connectivity with regional payment systems across borders. This is the manifestation of macro digitization, and it portends a more fundamental change. From crypto speculative cycles, we're entering infrastructural cycles. The valuation frameworks are completely altered by such transformation. Longevity is more important than rhetoric when infrastructure is considered. There has been a change in focus from discussing the quickest pumping token to discussing the network with the most counterparties. That is an altogether separate measure. More specifically, let's look at the institutional layer. Big banks and other financial organizations are pragmatic, not ideological. Management of risk, scalability, compliance, and liquidity are their primary priorities. The widespread adoption of a blockchain network is dependent on its compatibility with existing infrastructure, including systems for identity verification, regulatory reporting standards, and frameworks for capital requirements. Ripple has been quietly making its way into these high-profile institutions. Memberships and participation with global regulatory authorities, alignment with derivatives associations, integration with custody providers, employing multi-party computation. Systems for stablecoins designed with compliance in mind. These traits are necessary for institutions and not for the public. Think about stablecoins now. XRP Ledger is witnessing the deployment of stablecoins by issuers with ties to sovereign nations, as well as tokens backed by the Singaporean dollar, the Australian dollar, and the Brazilian real. These digital representations, tied to cash and integrated into regulated ecosystems, are not meme assets. To connect conventional banking with blockchain liquidity, stablecoins were the first of their kind. Additionally, liquidity becomes borderless when those stablecoins are able to travel across chains using interoperability protocols. So that's the big picture. Financial systems rely on liquidity. The efficiency of capital increases when liquidity can flow freely between networks. Settlement times are reduced, counterparty risk is lowered, and new financial products are unlocked as a result of this efficiency. Now incorporate tokenized treasuries, on-chain escrow mechanisms for structured financial instruments, and CME futures markets that reference digital assets. XRP is being positioned as the router, not the only chain, in the emerging unified global settlement layer that we are witnessing. There is a powerful difference, but it is subtle. It links networks together rather than competing with them. It is like financial TCP/IP in concept. As soon as the internet was available, competing businesses set up shop on various websites and applications. Underneath it all, though, the protocol layer standardized communication invisibly. Unlike apps, protocols have a unique way of capturing value. The value they derive is based on transaction throughput and network effects. Up next, we'll discuss rules and regulations. Institutional crypto adoption was hindered for a long time by regulatory ambiguity. Banks want everything to be clear. Capital handling, custody regulations, anti-money laundering duties, and compliance frameworks for cross-border transactions are all areas they must be familiar with. Speed is a natural consequence of the gradual loosening of rules around the world. With the regulations in place, organizations can confidently distribute funds. We will soon reach that tipping point. The adoption curves for blockchain technology will rapidly steepen as banks go from sandbox experiments to production-level deployments, and the numbers point to the fact that we are now witnessing the beginnings of it. Increases in the tokenization of actual assets do not occur at random. This represents the transition from experimental to implemented institutional practices. The incorporation of digital identities into CBDC pilots is not an abstract idea. Changes at the level of sovereign infrastructure are reflected in it. Significant cooperation is shown by the syncing of payment rails between domestic systems and blockchain-based settlement layers. This is not a stock market investment. At the policy level, this is a shift. What follows is an examination of the immediate future. Even now, market conditions are somewhat unpredictable. The cryptocurrency market continues to repeat itself. Factors such as interest rate expectations, global risk appetite, and monetary policy continue to influence liquidity circumstances on a worldwide scale. There will always be a short window of opportunity where price activity exceeds fundamentals. Markets will experience sudden upswings and downturns due to speculation. However, infrastructure development persists despite this unpredictability. Institutions will have easier access to XRP Ledger after permissioned DEX functionalities are activated. Increased product design adaptability is brought about by enhanced token escrow capabilities. To improve routing efficiency, cross-chain liquidity bridges are used. These upgrades are fundamental. Speculative storylines, price ranges, and resistance levels are common targets for short-term traders. Infrastructure is the primary focus of long-term capital. Now let's talk about the future. What I refer to as the tokenization decade is upon us. Tokenization will become more commonplace in the coming decade for a wide variety of assets, including stocks, bonds, property, commodities, and even private loans. Rather than being in vogue, programmable settlement is advantageous since it lowers operational expenses. Interoperability is crucial if tokenized assets are stored across several chains. Liquidity that is too tied to one network is a nightmare for asset managers. No government agency desires the segregation of its digital currency. Delays in cross-border payments caused by incompatible rails are something no international firm wants. Maintaining interoperability is essential. You can't avoid it. Networks with the ability to act as liquidity routers become structurally important in such a setting. That is the very essence of XRP's value offer. Asset for neutral bridges, fast processing speed, cheap buying and selling, compatible with a variety of rail systems, in line with systems for ensuring compliance. That gets it in a good strategic position, but it doesn't ensure dominance. Return to the macro lens now. Here we are seeing the very essence of worth being digitalized. Layers of intermediaries, clearinghouses, correspondent banks, settlement agents, and custodians have been integral to the financial system for ages, added complexity, time, and money with each successive layer. Layers are compressed using blockchain technology. They are further compressed via interoperability. Money, assets, identity, and compliance all function together across networks in a single unified global OS for value exchange. The finished product is still a ways off, but the foundation is in place. Commercial banking rails are being integrated by CBDC pilots. Verified issuers support stablecoins. Bonds issued by the government digitally. A protocol for routing data between chains. Integration of institutions providing custody. Now we enter the phase of peaceful convergence. In the past, there have been periods of convergence followed by periods of exponential development. Most individuals in the early days of the internet failed to see the significance of protocol levels. Websites were their primary focus. They came to understand later on that the real worth was in the connection itself. Potentially, cryptocurrency might do the same. Networks that integrate with existing infrastructure have a better chance of lasting than speculative coins. First things first. It takes time for an adoption to take place. Reserves in the financial sector are prudent, and rightfully so. Faith is delicate. Speed is less important than stability. Therefore, it is impossible to exaggerate the significance of the multi-year head start in terms of regulatory engagement, sandbox testing, and institutional integration. Earning someone's trust takes time, but once it's done, it makes you more defendable. The ability to defend one's financial infrastructure is also very potent. The instability in the short term will persist. The stories will switch places. Stunning technical specifications will accompany the debut of new chains. For trillion-dollar inflows, however, banks prioritize uptime, compliance compatibility, and dependability in their infrastructure choices. That's the right way to look at the whole blockchain war. Rather than as a popularity contest, it's a race to get fully integrated into the plumbing system. Everything else will make more sense if you grasp that context. Chain versus chain isn't the actual competition. The issue is divided liquidity as opposed to united liquidity. Networks that are not interoperable are known as siloed networks. Infrastructure that is ready for production stands in contrast to experimental infrastructure. Aware of institutional realities, the XRP ledger has evolved into permission trading environments. Fully anonymous, unrestrained markets are not a good fit for banks. Compliance enforcement, audit trails, and controlled access are necessary for them. The ledger adjusts to that need without giving up on open market structures by making member-only decentralized exchange functionality possible. The hybrid design is quite effective. When it is suitable, open liquidity. Where necessary, permissioned liquidity. Similarly, programmable finance is made possible by token escrow's growth beyond native XRP. It is possible to administer collateralized instruments, syndicated loans, structured notes, and vesting schedules on the blockchain using preset logic. This improves transparency, shortens settlement times, and decreases administrative overhead. Next, think about corridors that span international borders. When liquidity is efficiently routed, emerging markets stand to gain a great deal. Many regions still have significant remittance fees. Delays in settlement lead to inefficiencies in the use of capital. Due to payment friction, small and medium firms often have liquidity restrictions. These limitations are lessened by interoperable blockchain rails. Capital velocity is enhanced when a payment can start in one currency, go through a bridge asset, and settle instantaneously in another. Speed is important. Economic growth is bolstered by a higher capital velocity. That's the reason why all eyes are on the central banks. You can't expect CBDCs to magically replace cash. The focus here is on updating the systems that transfer funds. Policy instruments are enhanced when digital currencies issued by sovereigns are able to communicate with those of commercial banks and cross-border liquidity networks. The transmission of monetary policy is enhanced. Trade between countries is getting easier. Financial inclusion is growing. One possible early implementation is Bhutan's combination of digital identification with programmable cash infrastructure. Integrated identification compliance, cross-border compatibility with neighboring systems, and QR code payments for retail services. This is thinking at the level of the infrastructure. The use of private XRP ledger architecture for issuance and settlement by that infrastructure shows that institutions have faith in its reliability. The topic of valuation has been revisited. An item presented as connective tissue raises some interesting questions for potential buyers. The demand for transactions is what gives value to bridge assets. They may be able to collect more routing volume as the number of networks they link increases. A structural increase in routing demand is possible in the event that tokenization spreads, cross-border settlement moves on-chain, and CBDCs interact with commercial systems. So that's the big picture. Still, you'll need to be patient. It takes years to build out infrastructure. Once a critical mass is reached, the adoption curve becomes much steeper after starting off slowly. That curve is probably still in its early stages. Long-term structural positioning remains unaffected by short-term price movements. And still, danger lurks. True, there is competition. New options for achieving interoperability are appearing. The regulatory environment can change. Sometimes security holes in technology become apparent. Success is not guaranteed by any network. However, placement is critical. Consistent with the historical development of global banking, the XRP ledger opts for integration over isolation. Quite slowly, working in tandem, leads by standards. Volatility may rise in the near future as markets process new regulations, changes in macro liquidity, and shifting narratives surrounding tokenization. Notable events could be hastened via institutional pilots. Increased on-chain activity could be a result of stablecoin expansions. New participants may be attracted to permissioned DEX adoption. However, the key indicator will be the continued increase in the amount of cross-border settlements and the tokenization of actual assets. Pay attention to the plumbing, not the cost estimate. In the grand scheme of things, no one entity will be able to exert control over any future unified global operating system for value. Built on top of existing routing protocols and assets, it will be a network ecosystem that can communicate with one another. Those who have established themselves as vital connectors will emerge victorious in that system. Affirmative, the blockchain conflicts are getting hotter. However, retail speculation is hardly the front line. It's the framework of the institution. Institutions, meanwhile, act with purpose. They check, they combine, and they expand. They are seldom reversible once scaled. So keep one question in mind as you survey the terrain. Which networks are constructing the links? For the simple reason that bridges are invaluable in a disjointed environment. Instead of focusing on which coin had the most dramatic marketing campaign, the next 10 years will likely be characterized by the protocol that stealthily made its way into the world's financial networks. Longevity resides there. There, compounding takes root. Therein lies the genuine macro opportunity.